Fed's aggressive rate hikes are a game changer. What? So maybe the Wall Street Journal is just finally getting this, but I found a nice article today I wanted to share with you guys, and it's actually a video. And I watched the video earlier, and it's like, wow, that's exactly what I've been preaching for the last year. And it's a lot of Wall Street people. It's Federal Chairman Powell. It's a whole bunch of people in this video, and they're explaining what they're doing and the whys behind it all. So check it out, and then when we come back, I'm going to explain to you why I'm showing you this video, because it's a game changer, especially in real estate, if you're looking to buy your first house or maybe investment property. So check it out.
Last year, policymakers were convinced that inflation would be
transitory.
Temporary.
That's a transitory thing.
But over a year later,
I think I was wrong then about the path that inflation would take.
For most of 2022, inflation lingered above 8%, a 40-year high. It's affected everything from gas prices to groceries. But why has it lasted longer than many experts expected? There are a few key factors that propped it up and made it tricky to predict what comes next. The first is consumers have more to spend. At the beginning of the pandemic, emergency measures from Washington, including stimulus checks, loan pauses, low borrowing costs, and more, flushed the economy with cash.
And those resources really built up, and it was a large stockpile of dry tinder that was ready to spend as the economy loosened up.
This is the U.S. personal saving rate, the amount of money households have left over after they spend and pay taxes every month. This spike and the ones that followed contributed to $2.3 trillion in extra savings, which is one of the reasons consumers have continued to spend as prices have gone up.
There was pent-up demand. Humans are social animals. They wanted to go back out to restaurants. They wanted to see their friends. They wanted to visit families. It resulted in more spending, but it also resulted in companies demanding higher prices.
The Fed estimated that there was still a stock of $1.7 trillion in excess savings in mid-2022. And as consumers have continued spending, companies have been hiring to meet that demand.
There was just such a demand for workers after the pandemic that companies had a lot of openings for positions that they just couldn't fill in an environment of very low unemployment.
Here's a chart that helps show just how strong the job market is. This is the number of job openings, and this is the number of people who are unemployed.
On the one hand, you have an excess of demand from all the money in household bank accounts, and the other is you have a deficit of supply from shortages of not only workers, but also goods sourced in global supply chains.
To help try to fill those vacant positions and encourage workers to stay on, businesses have also raised wages. Compensation for private and state and local government workers has grown by 5% from last year. But when companies raise wages, they often raise prices to make up the difference.
As wages go up, companies respond by raising prices. Well, as prices go up, people say, my cost of living is going up, you got to increase my pay. And this process starts feeding on itself.
But aside from consumer spending power and the labor market, inflation has just been a really hard target to hit.
It's kind of been like watching a game of whack-a-mole. Every time you see inflation pop up in one area and think you understand it, it puts its head down and pops up in some other area.
Price increases have rippled through the economy at different times. In 2021, prices for things like groceries, cars, and gas were pushed up by economic recovery from the pandemic. Then, in 2022, airline tickets rose as well as the war in Ukraine drove up the price of jet fuel. And as some of those prices started to ease, housing kept going up as the economy reopened and rents increased.
So inflation has run right through your home, from the stuff you put in your home, the televisions and the furniture, to the actual cost of living in the home, from the goods sector to the services sector, right there in your own day-to-day life.
And that bouncing around has made it harder for the Fed to forecast how long policies need to be enacted in order to bring inflation down.
I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing.
It's using this instrument that hits certain sectors of the economy harder than others. So it raises interest rate, which raises the cost of interest in interest-sensitive sectors like housing, but it might not hit other parts of the economy where inflation is acute.
The International Monetary Fund says that interest rate increases have their peak effect on inflation after 3 to 4 years.
Monetary policy has long and variable lags, which is another way of saying it takes time for these effects to work their way into the economy. And the backdrop to the economy is constantly changing. That's the variable part. So it takes time to play through, and how it plays through is unpredictable. So the story is still unfolding.
Okay, so you can see how that video kind of reverbs all the information that I've been giving you over the last year. So I'm not trying to build my credibility. What I'm trying to do is at least inform you guys. Guys, it's not me just saying it. It's economists on Wall Street that's saying the same things I am. Fed, please calm down a little bit. Give this a little bit of time to work, because we just found out that it usually takes about 3 or 4 years from all your actions to really go into place. But I also have a plea out there to all of us consumers out there. Please stop spending a little bit so the inflation numbers can come down, okay? But there's a bad news on that front as well, because we're starting to see the disposable income from families really going back down to worse than we were pre-pandemic. And we're starting to see credit card usage and credit usage in general spiking at the fastest pace we've ever seen. So that is some scary news coming around the corner. But with nothing else there to say, let's go over the economic calendar for the week. There's really not too much for the week, but there's an action-packed Wednesday. Let's go through this and see what might affect the markets coming in. So we have building permits. That's probably not going to really do too much to affect the markets. Then you have core durable goods orders. How much people are spending on durable goods, like machinery that's, not just goods and services. It's just like for a refrigerator or a washer or dryer, things like that, major items, durable goods. So is all these actions the Fed's doing starting to take a chunk out of that? We need that to happen. Okay, then initial jobless claims, that's another area that the Federal Reserve is going to be watching. Why? They have 2 mandates. One is price stability, aka inflation, and the other is jobs. They want jobs at their maximum capacity, so they want to see what the jobless claims are looking like. New home sales, probably not going to be enough people working on Wednesday for this to really affect the markets. Crude oil inventories, the previous reading was negative 5.4 million barrels. But the good news there is we're seeing gas prices come down. How long that's going to be, I don't know. And then what also comes out on Wednesday is the FOMC meetings. This is the Federal Reserve meeting minutes. They'll come out and tell us exactly what they said at the last meeting. There shouldn't be any surprises there. And then the rest of the week is really nothing. So why are you really here? Well, you're trying to figure out when the heck's going on with mortgage rates. So for that, we go over to here. Let me refresh this so I get a fresh screen for you. It went from up 3 to up 20. Okay, so did you see that? It went up 3. Now we're up 23. So what's happening? Well, this is nothing but good news. What you're seeing on your screen right now is what's happening to the price of a mortgage-backed security bond. This bond is trading on Wall Street. So what's happening is you're seeing it trading live as we're seeing this. The thing I want you to take out of this price, what you're seeing on the screen, is a price. You can see how it's up 0.22 plus. Okay, when you see a plus sign, that means mortgage rates are getting better, because the plus means what's happening to the price of a mortgage-backed security. So as the price goes up, it has an inverse relationship on the yields or rates. So that means rates are coming down. So this should see rates come down about 10 ticks. So where are rates right now? Well, this is where we ended on Friday. What you're seeing on your screen is the top 6 products people use when they're buying or refinancing a home. So you see them right on your screen. These are issued by Mortgage News Daily on a daily basis. If you want this same screen, just click down below and you're going to hit the Mortgage News Daily live rates, and you're going to find that. But if you want this and a newsletter and a whole bunch of other things to make you informed or a more informed real estate person, well, check out my newsletter down below, and you're going to get it every day, and especially one every Friday to give you a recap of the week. So this is where mortgage rates are right now. The nice thing here is you can see right through here, the 52-week high and low on rates is we were just at 7.37 on the 30-year fixed not too long ago. So we're about 75 basis points lower right now. Okay, so from where we were, a nice trajectory from where we were. So what happens is normally in a recession, because I'm saying we're in a recession. A lot of economists are saying we're in a recession now. Most of them are agreeing that we're probably going to be in one by Q2 of next year. The last 5 recessions, we saw mortgage rates go down over 1.8%. So we're starting to see that coming into effect right now. So if you find my video informative, entertaining, and everything else, and you would like to find out more about me and my team, how we might be able to help you, either 1, get pre-approved to buy that first house, 2, maybe you're looking to build a house and you need a long-term rate lock, I'd love to help you there, or 3, you've already went out there and got a quote, a mortgage quote from somebody, well, we have a free service. Let's check that quote or scan that quote to over 80 of the country's largest banks and mortgage companies and see if the quote you got is good. But what's happening in most cases, we're able to find you a lower rate, lower fees, and in most cases, we're finding you both. We're finding you lower rates and lower fees. How do you figure out this? How do you figure out if anybody else has a better rate for you? Well, all I need you to do is click right here. You're at therateupdate.com. You're going to click loan estimates, free service. You're going to click there, fill out this information below. And what you're going to do is you're going to drag and drop your loan estimate right in this bin right here. It's a secure website that it's going to come to me through this system. What I'm going to do is review this. Then we're going to get back with you probably within the hour. And in most cases, it's with some fantastic news that we're able to save you money on your payments and your total closing costs. So that's my report for today. If you find entertainment value in this and educational value, all I ask you to do is give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. God bless, guys. Thanks so much for watching. I'll see you tomorrow. Bye-bye.